News. Avery Shenfeld is chief economist at CIBC World Markets, and based on data compiled by Bloomberg, he's one of the most accurate forecasters for both non-farm payroll data and GDP numbers. That's what we call a Bloomberg best. Avery, thanks a lot for joining us. We appreciate it. So,
you're welcome.
First of all, let's talk about that unemployment rate going down. Why isn't it good news? More people just not looking for jobs?
Exactly, particularly young people. So at this time of year, kids come out of school. Typically, they start looking for a job. What happened this month was, while some of them did, not nearly as many as normal. So in fact, what the data showed is that relative to the seasonal norms, we had fewer students looking for a job. And since some of them are typically unsuccessful, actually, it makes it look good. They're not looking, so they're not unemployed. But of course, we know that the reason they didn't look is because they'd already heard that it was a hopeless task.
So big picture here, Avery, is the data today consistent of economic slowdown or a full-on double-dip recession here? And how many points is it going to shave off the economic growth pace?
Well, the trouble is that at a turning point like that, from good growth to not so good, it can either look a lot like a recession or just a slowdown. And at this point, questions still up in the air. But the kind of numbers we're seeing now, certainly consistent with our view that by the time we get into the fourth quarter, the economy may be growing as little as 1%. So I don't think yet we're seeing the kind of data that's the all-out recession story. But this is certainly below trend economic growth, what we're heading for here.
Well, Avery, our Dominic Chu earlier took a look at if we were adding X number of jobs per month, how long it would take us to get back to the pace of employment where we were a year ago or a couple of years ago. It's going to take a long time if we keep it up at this 12 years, if we keep it up sort of at the pace the past couple of months. I mean, what's your view? How long is it going to take to get back to quote unquote normal levels?
I think we're looking at several years. We need to do much better than these sorts of numbers. You need to get private sector hiring up around the 300,000 mark to start closing that gap. We're nowhere near that. And that's where I think one way that the market has it right is they've pretty much been pricing out the prospect that the Federal Reserve will be raising interest rates this year, probably next year as well, and with very good reason, because if there's an ocean of unemployed now, there's still going to be an ocean of unemployed next year.
So then the question is, how do you spark job growth? Is it an extension, say, of government stimulus or different public policy specifically to boost growth? What's your opinion?
That's a tough road, but one thing you don't do is you don't tighten fiscal policy dramatically. So forget about fighting the deficit in the near term. And if anything, you might need a stimulus too at some point to keep people working until the private sector is in a position to spend enough on its own. You need monetary policy to stay very stimulative. Zero interest rates from now, really as far as the eye could see, or something close to that. And maybe we'll even need the government to go back to quantitative easing. So all of the weapons we brought out that we thought we were done with when the economy showed a recovery, we may need to go back to that list again if this recovery truly sags.
And Avery, what can be done about sentiment? Because do you get into sort of a vicious circle situation here where consumers see these types of economic data and these jobs numbers specifically, and that then makes them more reluctant to spend?
It does, and I think that what we need is some reason for them to spend. Now, the market's giving them a bit. We're giving them very low interest rates, not just on short-term interest rates, but now on 30-year mortgages as well. So that's certainly a bit of a help. But I think that what we've seen, for example, in the housing data is that a lot of the spending was when you had a tax incentive to buy a house, you did it. When you didn't have that incentive, you dropped off. So we certainly need something in the economy to encourage people to see the brighter side of the picture. And that's why I think that talk about deficit restraint, for example, may be exactly the wrong message to be sending right now.
Avery, thank you so much for joining us. We appreciate it. Avery Shenfeld is chief economist at CIBC and one of Bloomberg's best. Avery, it looks like everybody else has left your office, so I hope you can soon too. But thanks a lot for doing this. Appreciate it.
So